Ramsey, who leads our tokenomics capability at HLV. Yeah, Vincent and I, we work closely day to day with our advisory and token launch clients, and just excited to share with you an overview of what's involved in the fungible token launch projects that we typically manage from end to end. So just a little bit about HLV for some context before we begin. So at HLV, we advise projects, we build products, and we invest strategically in early stage founders and teams. Our team is really best known for partnering together with Yuga Labs, and there, we serve as the strategic, operational, technical, and the tokenomics minds behind the ApeCoin fungible token launch, and that went live back in March last year. And since then, we've just continued to develop our token launch playbooks and build out our Web3 advisory practice. So definitely reach out to connect afterwards. We love learning about new perspectives since our space is constantly changing and we're continuously adding and tuning our processes as strategies adjust. So as we transition to the core topic around fungible token launches, there's, of course, a YOLO way to launch a token that might not require so much involvement from many different parties. And you can probably, launch that with a dev or two and a Discord and a Twitter. And we do see these kinds of tokens get launched every day. It's not quite the context that we're working in and that I think the audience and the presenters here are working under. And really for us, we work best in partnering together with those teams that are looking to launch tokens that drive decentralization of their product or protocol, that really want to make sure there's effective execution and compliance throughout the entire process. So with that, I'd really just like to jump into the main slide I wanted to share. And it's really the overview of what's involved in a fungible token launch from our perspective. I'll warn you, there's a decent amount of content packed into a single slide, so I'll do my best to focus on each of the specific sections. You can definitely take screenshots or grab a copy of the slide to digest afterwards. And we'll also have a blog with some articles that might provide additional color to share afterwards as it's helpful. So we'll be a bit focused more operationally, at least for this introduction. So we'll share typical timeline, work streams, roles involved in the token launch process. And just follow along with me as we look at the overview section that I've highlighted in red. And it highlights what constitutes a token launch event and some of the success factors. So when we think about a token launch event, we can really break it down into some key parts. The actual event in itself, right? First, there's the whole technology deployment piece of it, the actual technology getting deployed on mainnet in production. This includes the token itself, any airdrop or claim mechanics, the technical sequencing for the wallet distributions, and the smart contracts and front-end code that are needed to support all of that. In many cases, we're not just launching a token additionally, but also pieces of a product or a platform, and in addition to that, integrations with the token that will need technical coordination on day one of launch. So that technical deployment piece is a huge sort of part of what we think of when we activate or go live with the token. We also see exchange listings go live on day one with market makers and liquidity providers to support those exchange listings. So for instance, for ApeCoin, we had 40 or so exchanges go live on day one and list the token on day one. So that required, a good amount of work and coordination leading up to that event, and trying to get all of those pieces together all in the same day. There's also the decentralization part of it, the foundation and the DAO going operational at the time of the token launch, and all of the sort of aspects and components and tool sets that go along with that. And also any partner integrations and marketing and comm strategy to push in the aid of the network effect that happens on day one of the token launch and the TGE itself. Really, the main point is that there's just a lot happening at the token launch in itself that just requires a lot of coordination to be able to get there. And we've also included some success factors to think about, and we're happy to continue to expand on that in further sessions. So next, we really see that, in terms of timeline, we typically see in our view, we typically see 16 to 20 weeks for the entire end-to-end process. And again, it's going to vary depending on where a team is at, where their sort of prerequisites, where the dependencies are. And we typically split the process up into 3 key phases, into planning, implementation, and launch. And in planning, really, that's where the core tokenomics requirements, the token economy, private-public sale, if applicable, are thought through. The different claim mechanics, token allocation and distribution, and alignment with the protocol and the product that are actually being built in parallel. All of that is being aligned on. And we really think through every technical detail in the planning phase, even down to what the sequencing and the solution for the token distribution is going to look like, because ultimately someone is going to need to think about sort of coding that up and actually thinking about the exact sequencing of what will happen on the launch event itself. So in this planning phase, really what we want is to make sure that technical and tokenomics requirements and the legal framework are in alignment so we can start implementation and try our best not to have too much rework later on. Invariably, there's always going to be some level of rework as the project progresses. There's going to be some surprises, but what we want to do is try to mitigate that as much as possible up front. So aligning on scope is a really important component of the planning phase. We'll also prepare the white paper during that phase as well, too. Next up, really, we kind of launch into the more second half of the implementation, which is in the implementation phase itself, right? This is where the technical components end up getting developed. Smart contracts, front-end UI, product development, testing, validation all happen. It's also where DAO requirements for the DAO launch are developed, if that's a core requirement for the token launch. And market maker and exchange integration preparation happens. So all of that is really just getting ready for production readiness and the launch process in itself. So once we get into the actual launch itself, and when we're finished planning all of our individual components, during the launch phase, we put it all together, coordinating the launch events, work together with community and marketing, the different partners, and get the token launched. We also want to make sure during this phase that post-launch planning is put into place as well. If there's different monitoring and analytics characteristics, who's going to be taking over the DAO side of things, because it's typically sort of a foundation that will end up, taking over, on the management side of things. So, that's again typically in a sort of brief sort of overview, how we kind of move through the token launch process in itself. And there's also a variety of work streams and components involved that we see in end-to-end token launch. There's legal side of things, tokenomics, white paper, the technical components that we talked a little bit about, the market strategy in exchange listings, the decentralization and DAO components, the marketing and communications pieces, the different token partnerships that really need to be put in place to show the different use cases of the token itself. And then really tying it all together, the program management capability to keep all the balls juggling in the air as all these different work streams and components are being worked through. And after this, definitely happy to share different articles that we've developed that provide a deeper look into each of these components. So definitely those that are interested, encourage you to take a closer look.
Thank you so much, Kevin. Now we're going to hand off to David from BSL.
Great, thank you. I'm going to go ahead and steal the share. So thanks to Kevin to kind of setting that general framework for us and look at all the different pieces that are happening there and touching on some of the things that I'm going to touch on here. But first, let me introduce myself and who I'm coming with. So my name is David Lopez-Kurtz. I'm a securities lawyer based in the US. I've been working in Web3 on Web3 projects since 2016. So pre-ICO and beyond. So at this point, the entirety of my practice is focused on Web3 and now verging a little bit into large language model, mainly because of the overlap that it has with Web3 work. And as part of my legal practice, as an extension of my legal practice, I founded BSL Group. And so who are we? We're an industry-focused compliance, legal and consulting company that's meant to provide infrastructure for participants in this ecosystem who are playing in a really high-risk area. And so our goal is to create infrastructure to minimize that risk, to be able to identify it and to make informed decisions. So when we're speaking about the overall roadmap, and Kevin touched on this, the asset itself, and I'm going to use the term digital asset when I'm talking very broadly. We're talking about token launches here, so we're undoubtedly talking about fungible digital assets. More generally, these are going to be the ERC20 sort of tokens in our conception. But let's keep it broad. Whenever you're launching any digital asset, regardless of its form function, regardless of whether it is fungible or non-fungible, you have to look at the asset not just from the technical point, but from the legal and regulatory side of things. As we've seen, not just domestically in the US, but internationally, there's been heightened scrutiny on these assets as they are sold from the perspective of whether or not they constitute a security. That's a massive consideration that needs to be looked at when you are doing this launch. Now, if there are ways that these things can be shifted one way or the other, there are different facets that go back to your tokenomic model, that go back to allocations to the team, that go back to all of these different pieces, but it needs to all be done hand in hand with counsel. And so the biggest advice I give to anybody who's thinking about launching one of these projects is you need to talk to lawyers sooner rather than later, because the last thing you want to do is be deep into your project and then at the last minute have someone tell you, oh, this isn't going to work. That's where people do the cavalier thing and just say, well, let's see what happens. They might not catch us yet. There's a lot of projects out there, and I'm going to roll the dice and see if I survive this whack-a-mole being pioneered and championed by Gary Gensler. So don't recommend doing that. After you've looked at your asset and you've kind of determined your risk level, that's going to inform your jurisdiction. And it's going to inform the structure of your project. And this can be a little bit of a backwards way of looking at it, but I don't think it necessarily is, because jurisdictionally, what entity is actually doing the issuance is really important. And project-wise, what kind of project are you? A lot of projects think, oh, well, I can just create an offshore set of entities, and that's going to be enough to mitigate my risk as it relates to US securities considerations. That is untrue. That's not going to work. That doesn't help actually anything other than actually raising additional red flags. What you do see, that what does mitigate individual risk of a domestic entity that is looking to build a project, is when you actually reach a level of decentralization where there actually is a DAO. And that's a whole conversation unto itself of the fact that there are many things that call themselves DAOs that by any reasonable estimate are not. These things are not decentralized. They're controlled by a few key players, and that degree of centralization undermines the ostensible risk mitigation inherent to creating this very elaborate corporate structure using all of the additional necessary complexities of creating an offshore facet to what you're doing. So all of this needs to be looked at from a risk perspective, and then from a business perspective. Is the investment in doing things a certain way worth it to you as a project? And at the very least, going through the basics of understanding who you're doing business with is almost always going to be a lower risk proposition than not. Now, some will argue that this is anathema to the entire underlying premise of Web3, and we can get into a philosophical debate about that. I actually don't think that anonymity is the most essential function here. I believe that is the ability to affect transactions directly between participants without the centralized intermediary being the more defining characteristic. But that's another, we can have that conversation in the law school classroom. When it comes to mitigating your risk, when it comes to complying with the necessary requirements of existing within whatever regulatory regime you have ultimately ended up on, these are going to be part of what you need to deal with. Does not matter where you are, there's going to be KYC and AML specifically considerations. And then the Office of Foreign Asset Control, OFAC, the Department of Treasury of the US, is specifically mandated to look outside of the borders of the US for things that are a threat to the Treasury's scope. So simply moving offshore does not undermine OFAC risk. And I wanted to kind of blaze through that in case there were going to be any questions from the chat, because I know that there are a lot of questions generally when it comes to operating in this space, and it's going to be impossible given our limited time to dive into a fully robust expounding of every legal and regulatory risk and consideration that goes into one of these projects. So I wanted to leave some time to see if there's anything specifically amongst our participants or amongst the attendees, if anyone wanted to ask anything and have any kind of discussion.
David, I have a quick question.
Sure.
Given some of the US regulatory uncertainty, are you seeing people like, how do I say this? Are you seeing more people move away from the US as like a alternate strategy, or are they trying to make it work within the US? Like, what are your thoughts on that? And maybe some of the, I don't know, macro patterns you've been seeing?
Yeah, I mean, actually, it's been the inverse. People have, because of the reach of the US when it comes to touching offshore operations, and the fact that these things were not as risk mitigated as previously thought, I've seen an uptick in deal flow where people are doing direct sales of digital assets domestically, complying with the existing regulatory framework, specifically securities framework. And so what I see is people will say, you draft your documents and you're going to do a private placement. And this private placement says, our position is that this asset is not a security. We don't believe that it is a security because of these things, and it's going to have this active consumptive use, et cetera, et cetera, et cetera. We're going to do our complete analysis as to why it's not a security. Comma, that said, in order to sufficiently distribute this prior to the launch of our project, we are going to make sure that we can comport with securities regulations, and therefore are going to sell it, lock it up for a year, do all the things you need to do depending on your exemption from registration, and then you prime yourself for your launch. Because that's going to be one of the key differentiators between a digital asset that is deemed a security and a digital asset that is not. A non-security digital asset, you're going to see more often than not, is going to have an active, live, consumptive use. You need to have a reason for a reasonable purchaser to buy it, other than they expect it to appreciate in value. There's more to it than that, but at its base. So when you see sales of tokens or any digital asset prior to a functional project, that should be a massive red flag.
Makes sense. I can ask one more question and I'll leave it to the rest of the audience, but I'm curious what you're seeing both on I think today's topic is really focused on the process leading up to the token generation event. And I think everything you're describing is referencing that, right? Especially during the fundraising part. What happens after you launch? Like, what are some of the compliance considerations, like immediately preceding the launch? And if you can share any insights there, that'd be super helpful. Thanks.
Yeah, that's a great question. And it ends up being this moving target because there are regulatory regimes that look like they're going to touch certain projects, but don't explicitly touch them yet. And my general position with clients is there are best practices that we can adopt that will take a posture that is similar to a regulated entity, but a light version of it. So for example, from the point of sale and any future buying and selling of digital assets between yourself and an intermediary, you should be conducting on-chain analytics as it relates to whether or not there is exposure to sanctioned entities, scams, theft, these other things, which are relatively lightweight to put into place. You can create APIs as it relates to your UI that allow you to scan in real time. Even lighter than that, you can do periodic scannings of the intermediaries of counterparties to just kind of maintain your general level of internal record keeping of, hey, we're doing our best, we're taking reasonable steps to ensure that we're operating as a good actor, even before these things are explicitly mandated of us. And that's going to be my general position of taking a more risk-averse posture.
Thanks.
Thank you so much, David. A reminder to the audience as well, you can use the Q&A function at any given point to submit your questions, or you can just raise your hand and we can allow for those as well. Next, I will pass over to Julia from AlphaLab Capital.
Hi, everyone. Just give me one moment. I'm going to share my slides. Okay, so I am going to give a quick overview of, what a token launch looks like from the perspective of a market maker. So this is a very quick introduction about AlphaLab Capital Group. We have been a crypto native market maker since 2017. And, we've traded on hundreds, possibly thousands of, small coins. And so, have a lot of experience in this area. So first I want to just define market making, because it's a term that gets thrown around a lot in the industry, but it's not always used accurately, right? Fundamentally, market making is an act of providing liquidity to enable other people to transact what, when, and in the size that they want. That's really what it's about. And so what does this mean, right? On a central limit order book, in every single transaction, there is a maker and there is a taker. So the maker is a person who puts liquidity on the order books, and then the taker is the one who takes the liquidity. The KPIs that a market maker is concerned with are primarily spread, which is the distance between the best bid and the best ask, the depth on the order books, which corresponds to the size of the orders that other people can transact against. We're also concerned about uptime, which is the amount of time that we're meeting these KPIs. And of course, latency is very important for market makers. One thing I will say here about spread and depth, right? So the way to think about this is the wider your spread is, you can think of it as a tax or a transaction cost that people who want to buy or sell or trade your token need to pay. So the thinner that spread is, the more cost effective it is for people to transact, right? And then the depth translates, you can think about that as, if you don't have enough depth on your books, then anybody who wants to transact a block trade or a large trade will have to pay a lot of slippage, right? So for example, if you only have a few, like $2,000 of depth on your books, and somebody comes and they want to place a $10,000 order, they're not going to be able to do that. So those are why the spread and depth KPIs are important. So one thing I also want to talk about is just to be very clear about what market makers do and what they don't, right? So the primary goal of a market maker is to help solve the cold start problem. And the cold start problem is, when you first list your token on an exchange, or if you're a startup exchange, you have very thin liquidity. And, by quoting the two-sided books, the market maker adds liquidity. Eventually, the goal is always for a market maker to work itself out of business and to get to the point where the marketplace has enough organic trading activity that a market maker is no longer needed. So if you think about, Ethereum, for example, Ethereum does not have any designated market makers, right? It just has enough organic volume that it doesn't need market makers anymore. On the flip side, there are some highly unethical activities that market makers are sometimes asked for. But any, credible market maker will never guarantee you a price, guarantee you a certain amount of volume, or engage in any of these other kind of practices to manipulate markets. Okay, so what do order books look like with and without market makers? Again, going back to the idea of our KPIs, when you have an active market maker on your books, you will have a tighter spread, you will have deeper depth on your books, and you'll have faster resiliency, meaning that when a large order is transacted, the order books will snap back to the way they were before much faster. And all of these things enable trading. And so the net result, right, can be that you have a lot more volume, but that is not the KPI that can be promised in and of itself. So let's look at a historic example of what happens when market makers enter a market. Over here, I have a graph of the average spread in the US equities market between 1994 and 2004, right? So the US equities market is probably the most liquid market in the entire world. And you can see that in 1994, the average spread was 100 basis points, which is 1%. That is huge. So in the 90s, that was when electronic trading and HFTs first emerged, right, with the likes of, Tower, Citadel, Jane Street, etc. And you can see that by 2004, they had taken down that spread to below 10 basis points. Today, the spread in the US equities market sits usually at below 1 basis point, right? In the crypto markets, you've seen something similar. If you go back in time to like 2016, average spreads in the crypto markets are much wider than they are today, right? And that is because of market makers. So thank you very much for your time. Happy to take any questions that people may have later on about market making for tokens.
Great. So I actually have a question here. One of the things that I think Kevin mentioned, right, is like ApeCoin went live on 40 exchanges the first day. Is this something that projects should aim for? Or, what does the sequencing on listing look like?
Yeah, that's a great question. So every exchange that you're on, whether it's a centralized exchange or a DEX or liquidity pool, every exchange is sort of its own market. And so what happens if you are on too many different venues relative to the amount of interest, right? The amount of trading interest that you have, it's going to spread out your liquidity. It's going to fragment your liquidity. And that's going to make it harder to get to the point where you have enough organic activity that the market makers no longer need it. So what we do is we typically advise projects to think about sequencing out their listings so as to give each market a time to form before moving on to the next one. We also think about incrementality, right? So there are some exchanges which have very different audience bases. So for example, if you think about, Coinbase and OKX, right? They have very different user demographics. And so if you're listing on both of those, it's incremental in the sense that you are opening up trading in your token to new people. There are also many exchanges which have a lot of overlap. And so if you're listing on 2 or more of those, well, are you really opening up to more users? Like what is the point of listing on 2 exchanges that have basically the same, user base, right? So those are some of the things that we think about.
Great. Thank you so much, Julia. Next, we'll hand off to Robin from Liquifi.
Oh, before I just have one more question, if that's okay. And then I'll present afterwards. I feel like it's a pretty opaque process. Like I'm not like a finance nerd. I don't know how a lot of these like terms work. So I'm curious, like, what is the advice that you have when looking for a market maker partner? Because I feel like there's a lot of information asymmetry where like, like if I'm an engineer or if I'm like a marketer, like I know how to do that, but I don't know, how trading works. I don't know how to think about slippage. So almost like if you could like explain like on 5, like how do you think about shopping around or like partnering with the right market maker?
Yeah. Okay. So some of the questions that I would ask are, how long have you been trading? How long has this market maker been trading? How much of their trading is their own proprietary trading? right? Because fundamentally, it's much easier from a technological standpoint to just be up and quoting on the books. It's much harder to be trading your own capital and being consistently profitable at that, right? So one of the things we're very proud of is we've been operating for almost 6 years and we've never had a down day in all that time. I would ask about how many exchanges they're connected to, because not all market makers support all exchanges. So if you are looking at a particular exchange for listing, it's important to ask if the market maker supports that exchange. I would ask about uptime and SLA. And I would ask about, whether the uptime that's guaranteed is a quoting uptime or a SLA uptime. So quoting uptime just means they're quoting at all, like they're active in any capacity. SLA uptime means that they are meeting the SLAs, the spread in depth KPIs that they have guaranteed. I would ask about the KPIs that they're setting for you and how they set those KPIs. So if they tell you, we're going to put $20,000 of depth on the books and we're going to give you a spread of 50 basis points. Well, how do they arrive at those numbers for you? Is it relevant to your project? Or is it just, the same number that they offer everyone else? I would also ask about kind of their ratio of projects to account managers, like how many token projects is each one of their account managers managing? How much personal support are you going to get? And then finally, I would ask about what has happened to their projects in past times of crisis. Like, what did they do when FTX happened? What did they do when USDC depegged, right? Like, how do they handle those situations? So those are probably the questions that I would ask a market maker if I were a token project.
Got it. Thanks.
We actually have one more question from the panelist. Oh, sorry. We have one from the from the audience. I think the second half of the question was answered by Robin's question, but the first question I think is very important. What is the commercial agreement that market makers have with exchanges?
Okay. So on all the large exchanges, the commercial agreement that market makers have with exchanges is like public information, right? So you can go and search on Binance's website and they have a page where they detail their DMM program. And so what it looks like is there's different tiers, and based on the volumes that you do as a market maker, you get placed in different tiers, and then the tiers have corresponding fees, right? So basically what it looks like is, as a market maker, the larger your share of market volume is, the more favorable your fees are. And then on some exchanges, those fees go negative in the form of a rebate. This is all public information.
And I think David has a burning question, and that'll be our last one.
Yeah, well, sorry. This is the best presentation on market makers in this space that I think I've been privileged to watch. So thank you for that. My question is, this goes a little bit outside of the specific mandate of this panel, where we're looking at kind of the traditional notion of a token and those launches, but I'm seeing a pretty significant uptick in tokenized securities that are meant to be secondarily traded on ATSs. And one of the real challenges facing ATSs is a lack of liquidity. Have you seen any movement amongst market makers to approach that space and provide the service that has been provided in traditional exchanges, and then on token exchanges that we see now in kind of this emerging space?
Yeah, I think that's a great point. To date, I believe that, as you said, securitized tokens have been a rather neglected area by market makers, and that's mostly due to the volumes there, right? So market makers generally want to go where volume is. But I think that is a super interesting opportunity. And, as you said, I think if we look at the long-term growth of this space, it's going to have to come down to real use cases. From an investing perspective, our firm is very interested in real-world assets and securitized tokens. So thank you for mentioning that. And that is definitely something that I think more market makers should support.
We have a couple more questions. So what about using market makers in tandem? Do you recommend one or many, or how many market makers when we list?
Sure. So I think that depends on, again, kind of your scale. It's very similar to the question of like, how many different exchanges should I be on, right? So I'll give you I'll just throw some numbers around. If your token is trading, say, $1 million a day, right? And you have $50,000 of depth on your books that your market maker has put there. That is more than sufficient. And putting more depth on the books with a second market maker is not really going to enable people to trade more, right? Because if you're trading $1 million a day, your users are probably not placing orders of like $100,000 at a time. So in that case, having a second market maker like doesn't really add any utility to your users, but you have to pay the second market maker. So it probably doesn't make sense. If you have, $10 million of trading interest and you are listed on like 10 different exchanges, as opposed to only being on 2 exchanges, then it probably makes sense to have 2 or maybe even 3 market makers, just so you have some redundancy and support, right? And also because some market makers support some exchanges and not others. So if you are listed on more than 10 exchanges, or probably even more than like, I'd say like 6 or 7. At that point, I think it's good to have 2 or 3 market makers, and I would probably recommend splitting them up across the exchanges.
Okay. And then one last question I think we've had from the audience. What do the different commercial agreements between market makers and projects look like?
Yeah, so there's a few different models that exist in the space. The original one is a token loan and option. So what that looks like is you lend me tokens. At the end of the contract, I have the option to either give the tokens back to you, or I have the option to give you back like stable coin, right, at a certain strike price. And the strike price is set at the beginning of the contract when the token starts trading. Then the second model that has emerged in the space is a retainer model. So this was like Flowdesk is probably the most well-known market maker that uses this model. It's very simple. They charge you, a few $1,000s a month to support your trading pair, and then there's no option on the token. There's also a newer model which has emerged, which is basically an OTC deal. So in that sense, the market maker purchases the tokens from the project at a discount to the spot price, and then the market maker has that inventory to trade. All of those commercial models each have their pros and cons, and I think they are suited for different projects in different situations. I'm happy to go more into depth about the pros and cons of each one, but I think I really want to leave time for the other panelists. So I'm going to stop talking.
Okay, great. Thank you. Now we can pass it off to Robin from Liquifi.
No worries. Julia, thanks again. Like I'm learning so much from our co-panelists here. And yeah, that was just like an amazing one-on-one there. So thank you for that. Let me go ahead and share my screen and also briefly introduce myself. So if I do this, can everyone see my screen still? Is that good? Great. So really quickly about Liquifi, in as few words as possible, we help protocols distribute tokens. And typically that includes employees and investors. And some of the features that we've built are smart contracts that automate your vesting and lockups. As I mentioned before, they're for employees and investors. But generally, through the process of setting up these tokens, there are things you have to consider from a compliance perspective. One of the more obvious ones being tax. And so especially if you are a US-based employee, you might want to consider how income taxes flow through. So those are some of the things that we help manage on your behalf. Some of the brands that we work with are the ones on the right. And so we've worked with a number of different protocols across different stages. And so, yeah, if you have any questions about how token compensation works or how you might organize like a community grant or even airdrops, more than happy to chat because, this is an area that we spend a lot of time in. Cool. So for today's agenda, I'm looking at the clock. I have maybe like 10 minutes or so. So I'll try to breeze through. I'll cover as much as I can, but generally I want to talk about what you should think about from like the pre-launch process all the way to the launch. And so that includes your planning, which I know HLV is very involved with. There are considerations with fundraising as a crypto company, and you might have tokens, as well as employee comp, and then tax situations that you also have to consider. So before we start, making it very, very clear that this is not legal advice. Everything here is meant to be for informational purposes only. So again, I'm not giving you financial, legal, or any sort of professional advice. This is just stuff that we've seen. Before we start, and I'm only going to spend like really 30 seconds here, most projects, I would tell them you shouldn't rush to launch a token. And I think we learned this in DeFi summer in 2021, where everything was sort of like in this, I don't know, drink champagne phase, and everybody was sort of like partying till the lights went out. But I think projects are getting a lot more smarter about if and when does it make sense to launch tokens. It's not enough to launch a token that has no clear utility or purpose and it's only a meme. I say that with like sort of like a joking tone, because I think we've sort of seen a trend over the past 4 weeks about these meme coins. But generally, I think you should really think about utility and having a clear purpose as to why you'll need a tokens. As a subsection of that, fundraising with tokens is also difficult as well. And so namely around some of the regulatory compliance things you have to consider. And yeah, like you should really understand like which VCs want to invest in projects with tokens and why. But all of this to say is that if you ask these questions for yourself, you will hopefully have a good reason for launching a token, as well as paying people with tokens and fundraising as a crypto project with tokens. And only when you have like the right legal counsel, the right strategy, then I think it makes sense to move forward. Cool. So let's talk about what it looks like to plan your equity and token allocations, primarily around your what we call like the cap table. The TLDR of what I want to share is that equity and token cap tables look very different, and so there are different considerations going into it. On the left is a typical equity cap table by the time you IPO, and the key difference between the two, as you can tell, is that on the left you have this huge portion that goes to investors, and then the founders and employees. On the right side, however, you have this big bucket that looks like the community grant, which is roughly about 55%. And that's more or less the purpose of crypto, right? Like if your tokens are concentrated in the hands of a few founders and your investors, that's not too different from Web 2. But in Web 3, people really want to leverage community and decentralized ownership as a way to minimize trust assumptions or just get more people involved, and also use it as a way to distribute ownership of whatever you're building, whether that's a DAO, a protocol, or some sort of like way to self-organize as a community. So because this community bucket is the biggest delta between the two, you should keep that in mind as you go through your planning process. You don't have quite the same size or allocations that you give to investors, so your go-to-market's different, your capital raising strategy might be different, as well as your employee compensation strategy. One interesting trend that I think is pretty obvious is where we came from back in 2017 to where we are now. Back in 2017, we had like more or less a lot of projects raising directly from the public through these public sales. And that's when we had that whole ICO mania, and projects had no trouble raising capital. But I think it was pretty obvious where we saw a lot of people starting to abuse that, and people would launch projects and rug a lot of the public members. And then it was more or less outlawed, right? Especially when the SEC got involved. And so you can see that really starts to show in this chart where this bucket of public sale dramatically decreases to now this the company reserve, as well as like the community incentives. And so it's a very popular strategy now to do some sort of like retroactive airdrop for people being like an early user or participant of the protocol. And that's a great way, or not a great way, but it's a tactic that projects use to recruit early participants and kickstart some of the network effects you need. So when you think about DeFi is not that useful unless you have liquidity. So if I have no liquidity pools on Uniswap, there's not much I can trade. If I don't have like if I don't have a marketplace of borrowers or lenders on Aave, then it doesn't make sense to use that protocol. And so tokens are a great way to bootstrap some of the initial like electricity that you need. And so that's the strategy that we're seeing. And so keep that in mind as you think about, okay, if I'm building a protocol and I want to incentivize my community, how much tokens do I need? How do I think about my airdrop strategy? How much portion do I reserve for them? Because that's one slice of the pie you have to consider. So I would look at similar comps for your protocol as a guideline. So, we have Uniswap, Goldfinch, ENS, DYDX. All of them had different pies, right? And for example, look at a Uniswap that had this huge portion that goes to the community. Same with ENS. And then, some of the other ones as well. These are all pretty similar patterns where we're seeing a pretty large portion of the tokens going to incentivize early engagement. So with that being said, we talked about the community bucket, but there's also the investor bucket as well as the founder and employees. You reserve, let's say like 55% or 50% for the community. Then you have the remainder that goes to investors and employees and the team members. I consider investors as like something that you're not trying to grow intentionally, right? I think most projects would prefer to bootstrap as much as possible. Investors are a way to like have people like take a bet early on, but not necessarily something you want to maximize. So it is a variable you consider, and then the remainder essentially goes out to your team. And the one that's go to your team, you have to think about how to distribute them in a strategic way. And so generally, it's proportional to the risk that you're taking. And so what's very common in equity compensation should hold the same principles as token compensation, where you want to allocate, let's call it X percentage that's much larger for the early, for the early employees, and that decreases over time. There are various resources for how to size these, which we can cover a bit later, but I want to at least cover that at a high level, just in the interest of time. Cool. So key takeaways: have a plan, use benchmark data, budget your tokens and equity according to the plan, and of course, roll with the punches as they come because things may change. So let's talk about fundraising really quickly. A lot of crypto companies, I think, rush to launch a token because they might fundraise from the wrong partners or they have like misaligned incentives. And so it's pretty common where you get a bunch of investors, you hire a bunch of expensive lawyers, you rush to launch a token, and then boom, right? Like your tokens don't really add much value and more or less goes to negative. And so there are legal considerations, there are strategic considerations, and there's a bunch of like compliance stuff that you have to consider. And so I would rather advise most teams to approach this slowly rather than rush it, because there's just so many things you have to get right. Working with partners like HLV is like a great type of idea because they've been through this. They know exactly all the gotchas to walk through. And so again, just be very intentional and strategic before you rush out. But if you do, then, we've seen various strategies being employed. I would say that the SAFT was very common, and I could be wrong here. I'll actually look to some of the panelists for additional input. I think SAFs are somewhat still used at times where it's directly in exchange of capital for tokens, but that more or less constitutes like a security. And so a lot of projects are thinking about, okay, I don't want to directly sell my tokens. Are there alternative structures where I might actually have the equity invested by the investor? And if and when a token is launched, then it could be distributed. And so we've seen some of these like side letter or warrant structures start to emerge. Talk to your lawyer to figure out like what is the right strategy for you. Cool. I wish I could go into this in more detail, but I think the key thing to note is that with side letters or warrants, there are different structures, and we've seen different ratios being used in terms of how much equity you get may influence how much tokens you get. And so there are various methods to decide that. I'll send out an article or post in the chat to go into some more detail, but just note that you should really understand the fine print. Try to figure out what sort of terms investors are using with you and using that as a way to determine whether or not you're getting the right terms or the right partnership. Cool. I'm going to cover this and wrap up just for Q&A, but on the employee token compensation side, I wanted to highlight what a lot of like founders I think are missing in Web3. Yeah, namely around like how to size your equity allocations as well as your token allocations. And so there's like a general rule of thumb where for hire 1, they typically get 2 to 3% of the total equity. Hires 2 to 5 gets 1 to 2, et cetera, et cetera. And also Sam Altman has like this rough benchmark here where first 10% goes to the first 10 employees, 5% to the next 20, and then 5% to the next 50. And so looking at your pie chart again, where you have 55 that goes to community, subtracting away the investor portion, let's call it like 20% goes to investor, you have maybe 25% to split between the founders and employees. And so whatever the right proportion is to convince your team members to join is the way I would think about equity or token compensation for your employees. Cool. Yeah, we kind of covered this as well. It's common to use the company allocation. So if I get 1% of equity and the company has only 20% of the overall token allocation, then applying some sort of multiple between the two, so you can get 0.2% of the tokens. That's a quick way to use the equity as a rough proxy for how much you should get. We've seen various structures, pre-launch as well as post-launch. Pre-launch, it's pretty common to use like some sort of document that says, if and when a token exists, then you will get a unit of those tokens. And then once it's live, there are various tax considerations of whether you use like the RSU equivalent, which we call like the RTU or restricted token units, or restricted tokens. Won't go too deep into it, but there are various tax considerations, the timing of the tax, when you actually quote unquote receive the asset on your sheet, on your balance sheet. Those are just things to consider with your HR/tax compliance lawyers. Cool. So let me wrap up. Key takeaways here is work with your legal counsel to use the right structures, again, around whether you can pay employees with tokens, what are some of the tax considerations. You can use equity as a great proxy, because I think there's like a lot of great precedent, whereas with tokens, there isn't a lot of great precedent. So I'll use equity as a way to proxy how much risk early employees are taking. And of course, have a budget, because I've seen so many times people misallocate or overallocate tokens to employees. They didn't have a sound plan in mind, and that just causes unnecessary dilution and a lot of like compensation inequity. Cool. Hopefully I was good on time, but I'll wrap up here. For any questions.
Okay. Yeah. I don't, do any of the panelists have any questions or?
Yeah, there was one earlier. I saw somebody asking for me about the near future of compliance. What do you think are going to be the project features that are going to be under strict scrutiny by agencies? Wanted to get to that, not miss that. I think there's going to be two big buckets that I want to just, if I'm going to caution people on. One are going to be projects that don't have features. If it's just a token for token's sake, huge red flags, right? You're just selling tokens to raise capital, huge red flags. They will get you for that. Two, projects that are expressively mimicking products or services that are otherwise heavily regulated and saying that it doesn't apply to them because they're on chain. Like if you're saying that you are creating bonds are heavily regulated. Just because it's a Web3 bond does not mean it's going to stop being heavily regulated, particularly when you yourself are referring to it as a bond. It's very difficult to then go argue, well, it's not a bond. You called it a bond. It says it right there, right? So those are the two big areas. Don't not have a function. And if your function looks like it's going to be heavily regulated, assume it's going to be, even if you've not been explicitly told that it's going to be, because it will, I promise.
Thank you so much for that, David. Yeah, sometimes it's pretty obvious, and then people don't always use their brains. Great, thank you so much, everybody, for joining. As I mentioned, Vincent, do we have another question?
I just had a quick question for David on the regulated sort of Web3 version of securities. Like really quickly, what do you think about the previous rise of mirrored assets and probably the retraction of those in a market like this? Like, do you think they're going to be more common in the next iteration of crypto cycles, or do you think they'll probably not be as common as they were last cycle?
I think that when we are creating mechanisms by which we open up new channels for people to exchange value, that's always going to be immensely powerful. And in the instance where you have these mirrored assets, that's a new and interesting way of creating mechanisms whereby people can have that exchange. I think the thing that's going to change, and this to me is going to be the next evolution of all of this, is going to be things that are no longer Web3 projects. They're just projects that happen to be taking all the technology, all the lessons we've learned, and seamlessly expanding upon that for the user. In the same way that it doesn't make any sense, or it'd be weird to hear somebody say that they're building their portfolio, in mobile. We're a mobile fund. It's like, what do you mean you're a mobile fund? Everyone's mobile. Everything's mobile. Like, yeah. Of course it's mobile. It's actually going to be the next phase to be of this is going to be the Web3 integration. It's going to be the way that we move between where we have been and then these notions of digital identity. But again, that's another conversation. But to answer your question, I think we're going to see more and more people experimenting with more and more ways to have direct transfers of value between counterparties. The question is going to be who builds those, who maintains them, who profits from them, and then in turn, who needs to meet all of the requirements and controls that will then be affecting the transfer of wealth and value.
And ideally something that's in a legally compliant as you can be, right? Like trading mirrored Tesla just because it's on, Ethereum, it opens a can of worms that probably isn't worth taking that risk to do, right?
Right.
Yeah.
And just having the conversation. I'll add one more. I know we're going over time, but I just want to touch on it because it's one that comes up all the time. SAFTs, safes, such things like that. No matter what, at no point was a SAFT not a security. The SAFT itself was always a security. The argument was that I'm going to sell this security, and the thing that gets delivered pursuant to it is not. That was the working theory when Cooley printed a white paper on the concept, and it was the modus du jour for a minute there. The SEC has since said, no really good reason why no, just no. So regardless, if you're doing one of those, know that it itself and the things that are delivered underneath it need to make sure that they fall within your exemption from registration and be treated like a security, unless you feel very confident that the thing underlying it does not qualify as a security, in which case, get rid of the SAFT and then sell them when they're live and they exist. And you're going to sell tokens. You could do a TPA, not a SAFT. The safe and warrant, if you're trying to raise money before your token exists, that model is better right now. That's the current sort of market standard. If you're interacting with VCs and they're looking to put money into your project, they're going to want to see a safe with a token warrant. There's a number of different reasons when it comes to that. Not creating a tax marker for purposes of valuing your asset before it even exists, makes it cheaper to get it to your team. There's a bunch of other ways of thinking about it, but then that safe, remember, is a security. People do safe issuances and be like, oh, I don't need to file with the SEC. It's a safe. It's a security. You have to follow securities laws when you're doing a safe. I know it's called a simple agreement for future equity. There's nothing simple about safes. They're short agreements, not simple agreements. So please talk to a lawyer, please.
Great. Thank you so much, David. Thank you so much to all of our panelists. I know if you put a bunch of experts in a room, we'll kind of go on forever. Like I said, this recording will be available afterwards. I will share with everyone. Have an awesome Friday. Or no, I guess it's Thursday in the US, but Friday for everyone in Asia. Talk to everyone soon.
Thanks, everybody.